Okay, good morning everybody, and thanks again for joining us. My name is Mark Flynn, Investor Relations at Novi Medical. Today we're covering the June 26 quarterly report, which we lodged last week with the ASX, and also we'll provide some outlook on FY27. Presenting as always today is Tom Sperling, our Managing Director. Again, Q&A available. If you look inside Zoom Q&A function, we'll look to get to as many questions as possible. Also, we can follow up post the webinar, but I will ask a number of questions, so please place them in the Q&A function within Zoom. As we can see from the recent results, Tom's led the company through a wonderful 4 consecutive years of sales growth, above 25%, and our FY26 closed at just below $24 million, up 26%, and the second half delivered the company's first positive EBITDA as guided by Tom and the team. So Tom will take you through these results, what drove it, and also to provide some FY27 guidance. So over to you, Tom.
Thanks, Mark. I'm very pleased again to be speaking and talking to our company. It's another record attendance, and having a lot of people interested in our company, another record attendance is webinar. Having a lot of people interested in our company is very, I'll just say heartwarming, because it is. Now you see our opening slide. Just leave it up there, sorry Mark, just back. Our opening slide, I just want to say, regular viewers will note that that's quite a change in our slide formatting, and that's intentional. We've hit some major milestones in this last half, and we are different. We're combining profitability with sales growth just as we promised. We promised it and we've delivered it. And it's a big thing today. Thanks, Mark. Let's just not forget glaucoma. The second leading cause of blindness in the developed world is a well-documented statistic. We build and design devices that enable surgeons to treat patients with glaucoma. Glaucoma is incurable, but we can delay the progression of glaucoma. Nobody can cure it. It is about a failure of, on the slide there, it's a failing of the eye's ocular irrigation system, blockages, causing a rise in pressure which cuts the optic nerve. Our glaucoma solutions work with the body's anatomy, open up the natural outflow pathway, and use surgical interventions to stop this without leaving anything behind. Tissue sparing. Very, very important. We are promoting the body to do its own work. Next slide. There's the top line. We want the message you receive today that the market we are in is early in the commercial growth stage of this market. We're early in our commercial rollout, and we've achieved strong growth. 26% year on year to 23.7 million. EBITDA positive in the second half as we guided, and EBITDA positive in FY27. We haven't put a number out, but we will be EBITDA positive. We are FDA cleared and MDR compliant. That MDR is, some people may consider it very boring. Some people who follow healthcare stocks know it was a milestone, a very important milestone we achieved during fiscal 25 to make sure that we converted from the CE mark regime into an MDR compliant regime. And the truth of the matter is that MDR has made it more, it is a higher bar than CE. It is closer to FDA. So we have we are well positioned to move forward and grow. Now I'll accept that I'm cheating with the scale a little bit here, but that's so what. I've put the numbers there. $9.3 million in fiscal year 22, following the release of our eye track advance over these last 4 years, we've got to 23.7, and we could do all the corporate finance maths on that, and that is a 26% compound annual growth rate. You almost couldn't make up a curve looking that so strong and consistent. And I ask you to put your rulers on that so that you can say, well, what could it be next year? We've given guidance, but I would like you to form your own view just on that trend. Next slide. Interventional glaucoma is the future. In this approach, surgeons treat the disease surgically and early instead of reliance on drops and the wait-and-see approach. I have, in our quarterly report, we flagrantly, and with the permission of Glaucoma, inserted some of their statistics because I think they have a really good outlook. They have a really good description. 90% of patients don't take their drops as prescribed. The old legacy of drops, and when it gets really bad, you drill a hole in your eye to relieve that pressure. It's barbaric. The idea of intervening surgically early to improve the outcomes with minimally invasive solutions like iTrack, particularly the tissue-sparing nature of iTrack, means that we have we provide better quality of life to patients, and which is wonderful, better quality of life for patients, but there is a business to be made. Doctors can make money out of that, and so it is a valid theme, a real theme that is only in its infancy globally. Next slide. So currently, glaucoma about 944 million, so that's not much. Well, I don't care. We only need a very small part of that. Glaucoma have said that by 2035, they estimate that there'll be just as many IG procedures as there are cataract procedures in America. Currently, there's about 500,000, 600, 700,000 cataract procedures, so they see that growing by 10 times. That is currently, we estimate that we have about 4%, 3 to 5%, put 4% in the quarterly report, of the interventional glaucoma procedures. In that means, I estimated in our quarterly report, we stated that there are about 30 to 35,000 procedures in the USA every month, and we're doing 4 or 5% of those and growing. So I often talk about this market share. Market share of 4%, oh, that's meaningless. It's tiny market share. Doesn't matter. That has developed 23 or 24 million of revenue for us, or 19 in America, sorry. And that just shows there's room to grow. And we're proving our platform can participate in that growth profitably. Next slide. Here's another depiction of the opportunity. These are estimates of cataract surgeons driving interventional glaucoma growth. That is, as I've said a number of times in these talks, 20% of the patients who present for cataract surgery have concurrent glaucoma, 15 to 20%. That presents the doctor with an opportunity to say to his or her patient, at the same time as me fixing your eye so you can see the golf ball or drive better at night, I can do a minimally invasive procedure that will which will get you off drops. The data says it will get you off the drops or reduce the number of drops you're taking, and that will improve your quality of life, all at the same time. And that offering by cataract and comprehensive surgeons is appealing to their patients. That is the space we're working on. That very, very simple concept that a patient doesn't have to go in and can get better vision through the cataract surgery and improve quality of life by getting off drops or reducing the drops. Without advice there, this green light and the green iTrack Advanced was just released in the last 6 months, and it, with the sheer clear technology, is driving growth. It is driving growth, I have to say. Next slide. This depicts, that's a cut-off version. We keep refining these pictures, but that's a cut version. The canal is theoretically wrapping right around that. But you can see a picture of our green catheter running through the canal. I actually personally believe that it's obviously a depiction. That canal is a bit fat on the left-hand side. It's thinner than that. But you can see the idea of our catheter running through that canal and clearing the blockages, and then we withdraw the catheter and flush it with viscoelastic shear clear, fins with the shear clear technology, our proprietary shear clear technology, to make the way into the collector channels, into the whole ocular system to reduce pressure and clear blockages. It works with the anatomy. We do not have an implant, and we do not tear the tissue. A note there about our reimbursement, or the reimbursement, $542 for the surgeon to do the procedure, $2,204. They're the current in 2026. Draft 2027 results were released, and they're approximately, by Medicare in America, and they're approximately the same. That we highlight as they will be confirmed, or we hope they will be confirmed. They should be confirmed in November later this year, but it provides confidence in our go forward American revenue, and therefore our guidance for our business. We're approaching 20,000 procedures a year in the United States with the device. A tiny part of the market, but for us, 20,000 procedures is good. Thanks. iTrack Advance is ready for the interventional movement. No trials to run. We have our approvals. There's no reimbursement to secure. Plenty of people on this call may be following various medtech companies that are trying to have deciding, will we get a FDA approval? Will we get reimbursement? When will we get first revenue? How are we going to get first revenue? And on this slide, I debated whether to depict revenue growth. We decided that we've only ticked first revenue. Revenue growth is what's about to happen. Okay? Very important. Let's go. And here's the revenue growth, lots of numbers, but it does show the dominance, 18.6 million in the United States, 30% year-on-year growth. Interestingly, in our quarterly, you'll see that our USA growth was 21% quarter-on-quarter. Really had a great quarter in America. Germany, it's steady, or it's growing, it's steady. Rest of the world out. Guidance is sales excluding China, 22.7, was above the midpoint of our guidance, 29% growth. And China, there's a, 18%, theoretically it's a big drop, and it's what, $200,000. It's not very much. We are growing in Europe. In China, we're only, it's lumpy, and we're only just getting started. Next one. So further, the opportunity in China, we consider that interventional glaucoma is only in a nascent stage outside the US. China lags most on interventional glaucoma adoption. The statistics say that when interventional glaucoma picks up, China will be there. Our investment in peak, I've had a few questions about our investment in China and why has it gone back, and et cetera, et cetera. Gone backwards to 18% loss. Well, first of all, it's a tiny amount. It's about percentages on small numbers. But second, our investment, we are proudly putting forward our EBITDA positive position. We put forward that EBITDA positive position because we're very careful with every dollar we spend. The opportunity in America is large. We invest in America hard. We are investing more slowly in China because we have that constant need to improve the bottom line at the same time. It will come. We are well positioned. We have our structure. We have our platform. But for the time being, we're excluding China from our guidance. Let's go. Now, dwelling a little, there's a lot of numbers here, but the messages are on the left-hand side. We hit our guidance target on revenue growth and EBITDA positive in the second half. And operating expense, regular followers will know, I often get asked about operating cost leverage. We've provided there a breakdown of the OPEX, sales and marketing, operations, product development, engineering, corporate and clinical data, so that people can look at the history and have a look at what is varying with sales. and they say, what's your leverage? What's your leverage? Lots of people are telling me that our costs just keep going up at the same rate as sales. Well, it's not. Our sales and marketing costs in the first half of 2024 was 76% of sales. That's a big number. In this last half, it's 52. The trend between 76 and 52 has been very consistent improvement. That data has all been provided historically. It's all in our releases. But one can assume then that progression will continue. However, we're not. So that someone called it Jaws. I've got a note about it being Jaws, the widening of the gap between sales growth growing faster than OpEx. That's where we are. So we got there on the EBITDA. We said we'd get there on FY26 guidance. We did, and in July we started F27 with continued growth in America. That's right up to today. Last Friday. Our guidance is 26 to 31 million US dollars in excluding China. People interested can add on for China what they will. That's between 15 and 37% growth. As I said, we point out we always have achieved 4 years 26% growth. So some people may say that 15% is too low, but we're not. That's what we're saying. We want to hit our guidance. We have not forecast what our EBITDA will be, but we are saying that it's positive. And as I said, we're tracking at 30% above in July. And we have liquidity in place that will facilitate us achieving these targets. You often say we don't have enough money. What are you going to do with capital raise? We have enough money to meet our FY27 guidance. Next slide. I think this is the last one. It's just getting started. We built our business for this exact opportunity. And it is now hitting the market, hitting the streets, and turning into fiscal outcomes that we think are interesting to our shareholders, that add value. EBITDA and sales growth. Nobody can tell me what's more important. Plenty of people say, oh, you're going to have sales growth. People say you've got to have a profit. We're doing both. More than 25% growth and EBITDA positive, we believe, makes a valuable company. And we think we do have a valuable company. Next one.
That's it, Tom.
There we are. So thank you. We'll just go back to the guide. Let's go back one slide there. And we'll leave it on that and we'll hear any questions, I guess, Mark.
Yeah, a couple of questions. One from Tom Wagner at E&P straight off the bat is, given the EBITDA positive, where do you plan on spending or investing that cash, and will it be in the sales force?
So we want to continue our growth. Investments in salespeople are, we're finding, have a very good payback period. So we worry about cash greatly, as one would expect. We don't have much. We have enough, though. And so, yes, the answer to that, Tom, is yes, we will be investing in sales growth.
And we've gone through the numbers in FY26. Obviously, the unaudited numbers have closed up, 23.7 in US dollars, so up 26%. You sort of covered a little bit. What really drove that growth this year?
Well, it's hard to go past America. That 30% growth, 79% of our revenue comes in the US, and it grew at 30%, and particularly that last quarter with 21% quarter-on-quarter growth. We think that in the last 6 months we released the ShearClear proprietary technology, the shear thinning technology that makes the OVD travel more through the ocular system. And the green light has been very well received by doctors. That navigational beacon, giving doctors the safety of navigation as they place the catheter in the eye of the patient. The doctors have liked it a lot better than the red one. So We have we have a bunch of good reps. From what I can gather, industry-leading revenue per rep. In our quarterly, we talked it's approaching, I think it was 1.9, close to $2 million annualized revenue per rep. And going back to Tom Wegner's question, we should have more reps. So that's where we are.
People are unpacking and coming through to me asking around corporate costs, falling in from 1.7 to 1.3, and also product development fell too. One of the questions was, were we under-investing to make the EBITDA number per your guidance?
So corporate costs have come down. There has been unfortunately, we have had to wind down our investment in, our spending on 2RT. And so that has been a big contributor. That has been a contribution to EBITDA positive. So in that large context, we are limiting. We think 2RT is really good tech, but we are not funded to be able to do it, as we've said a number of times. So in that context, maybe we are. But in terms of iTrack Advanced, we have an approved product. We are making changes, as you can see by the sheer clear and the green light. That is working within that sort of incremental improvement is working within our budget, which is make a profit, Tom, make a profit.
Good question from Paul Jones at Pack Partners. Are we expecting any changes to the reimbursement in the USA?
So we have, on July the 2nd, we received, the CMS announced the reimbursement for 2027, and as I've said, that was roughly in line with what it is for 2026. So one can never know what's going on beyond. That's 18 months from today, and those next 18 months follow the last, 18 years that reimbursement thing has been in place. So we have no reason to believe it's going to be changed.
Okay. Just on FY27 guidance, we've provided a guidance of between 26 to 31. The question is, it's a wide range. What separates the bottom from the top?
Well, I can be really honest and say, well, we want to hit it is one thing, but the top is what we think we can achieve, and I guess the bottom is what we know we can achieve. And think and know, for a little company like us looking out 12 months, it does relate to we could have confidence and but I think it will narrow over time, and will lift. I expect we'll be lifting that lower one, but it is about our ability to keep getting new accounts, and keeping those accounts. So lots of stuff goes into that. For now, for our little company, we think that gives our shareholders something to have confidence in.
One from Nick Lau at Taylor Collison. With the previous new sales rep hires that have been onboarded, have they transitioned into under-penetrated territories? How are they progressing, and what are they seeing on the ground?
So the last two reps we hired, the first one was in the Pacific Northwest, was absolutely an under-penetrated territory, and the other one is way up in the Northeast, where we split a territory where it was under-penetrated. We consider the revenue per rep number of 1.9 being an amalgam of bringing people on so that we don't let the sum drop to 1.9. Now, the person in the Pacific Northwest is not at 1.9, but she is not far behind. The person up in the Northeast is right up there. So it just depends, and we work on the total number because we are bringing on reps so that we try not to have too much of a dip in that annualized revenue per rep. The annualized revenue per rep is certainly a leading indicator of profitability.
Okay. Just on the 4C itself, talking cash and obviously the undrawn receivables and lots of questions throughout the last couple of days. So we had that cash plus the receivables. Is that enough to fund that growth and hit those targets?
Well, we've been very specific that our liquidity is enough to hit our targets. I know people would like to see more cash there, but that doesn't mean we have to have it. We are operating our company with great discipline, investing absolutely. You can see those investments, long-term investments in China are being deferred. So there are deferrals being made, but in the growth markets, we're making the investments we need using the cash we have.
And
so yes,
18 quarters of funding. So obviously based on that June quarter run rate, if we knock it out of the park, if and when we knock it out of the park, and what happens if you spend, and what do we need to spend to hit the top of that guidance?
We think that what we've stated is our liquidity position is enough to hit our guidance. That's what we've said.
Okay.
And 18 quarters, it's an interesting ratio, isn't it? I don't think in the history of Nova I we've ever had that much cash on hand. It's a relative thing, isn't it? We've never had 18 quarters of cash on hand. So there you go. We've got an unprecedented amount of cash at the moment.
On the market scope reports and sort of claiming that the market is at sort of US $944 million a year market, and Glaucoma is obviously the incumbent, and we've referenced them in the presentation as well. How does Nova I win against Glaucoma and get more of that $944 million?
So our pitch is tissue sparing, implant free. The Glaucoma solution is about putting a piece of titanium, or the Glaucoma stent is about putting piece of titanium in the patient's eye and providing an additional drainage pipe, just like we've been talking over the years about drilling a hole in order to let the aqueous humour flow. Now, we provide a tissue sparing working with the body's anatomy, and that offering is appealing to doctors because it's appealing to patients. And patients are what drive the doctor's behaviour. Now, plenty of people will say doctors are only in it for the money. Everybody has to make a living, but everyone also wants enduring demand for whatever service they're providing. And so enduring demand comes from offering good outcomes to your patient. And we think we've got a tissue sparing, implant free solution that is appealing. Morgan Micheletti, we walked around Sydney with one of our good customers, Dr. Morgan Micheletti from Houston, and his message to some of the fund managers we talked to there was absolutely tissue sparing, good for the patient, is why he chooses iTrack Advance.
The numbers sort of show that the iTrack is about 4% of the US procedures. It has grown. Some would say that's still low after several years. What's the growth rate from here?
So I think it's still low. Yeah, it is still low after several years. However, across those years, we've grown every year at 25%, and now we're making a profit. So I think we've grown at the right rate. Now, that just means we've got room to grow, not that we've got something wrong with what we're doing. Simple as that.
A couple of questions on China. There's always questions on China. We've made some statements in the presentation, but obviously China down 88%, on a low number, as you mentioned. But is there anything else happening in China to update people?
No, I'll just reiterate what I said. China is a nascent market. We had our approvals in place. Our investments will be conducted very slowly because we get fast return at the moment in America and in Europe. It's just maths. It's about managing that cash. It's just delivering what we promise.
One, noting the time, we might, if there's any further questions, get them into the Q&A. But what is the one metric investors should watch this year?
Well, I think we've provided a lot of guidance on that operating leverage. And there's statistics in the history which show you operating leverage. You can't go past the United States, though. We've got we have our own sales force. Where we control exactly what's going on. We have not passed the responsibility for talking to doctors to some big multinational who doesn't care about us. They are our own people that love us, selling our product, and who love the product. So it's 80% or 79% the last 6 months. That's going to continue to dominate. So watching our quarterly results, watching the quarterly sales in the US is a leading indicator.
Probably a good one just through now. If patient demand certainly is controlling our growth, and doctor demand, I should say, rather than patient, how do we get more patients and more doctors to find out about our product?
That's about boots on the ground. That is about that line item, sales and marketing. And plenty of people have their opinions on how much marketing we should do. And in the end, having reps in the territory talking to doctors is what gets our name out there. And having peers, having the clinical data, having the people so that the reps can talk to a new doctor and say, look at all this clinical data, doc. It works. And look at your peer down the road. He or she is using it. Why don't you give it a go? That message, and Nova Eye is, we're a substantial company. We've got, we're becoming well known. We have a group of doctors that follow us. That all gives confidence to potential new accounts, and that's what drives sales.
Thank you, Tom. Just again noting time, just gone past 12 o'clock Sydney time, but thanks very much to everyone for joining. If there's any questions, Tom and I's details are on all the releases. Please feel free to give us a call or drop us an email. But thanks again, and thanks to Tom.
Thanks everyone. Thank you.